Hey guys, Kevin Bupp here, Sunrise Capital Investors, also the host of the Real Estate Investing for Cashflow podcast. Looking forward to my time here today with Brian. We're going to talk everything and anything related to mobile home park investing, which is my favorite asset class, as well as parking lot investing, which is one of the niches that we also specialize in. So two very unique niches that we've been investing in for many, many years now. So very much looking forward to spending time with Brian and diving deep into these two respective investment niches.
Welcome to the Rental Property Owner and Real Estate Investor podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Get ready for the Midwest Real Estate Investor Conference in Grand Rapids, Michigan. Join hundreds of real estate investors for networking, learning, and growth. Be sure to mark your calendars for April 24th and 25th of 2025. Hello and welcome to episode 460. Today, we're going to be talking about investing in mobile home parks and parking lots with Kevin Bupp. Kevin is the owner of Sunrise Capital Investors and one of the premier mobile home park investors in the country with over $500 million in real estate transactions and 2 decades of experience. Kevin is also the best-selling author of the Cashflow Investor and the host of the highly rated podcast, Real Estate Investing for Cashflow. Kevin, welcome back to the show.
Yeah, Brian, thanks for having me, buddy. Nice seeing you again. And kudos to over 400 episodes, man. You've been rolling with it. I mean, that deserves a award in and of itself. And that most people start podcasts and they don't follow through after, mostly a short period of time, 6 months. Maybe they make it to 12 months, but you've been rolling with it for years. So kudos, bud.
Thank you. Coming from you, that's high praise. I mean, you have a top-rated real estate investing show. How long have you been doing yours?
Over 10 years now. I know,
okay. You got me beat then.
January of 2014, I launched it. I had intended to launch it January 2013. I bought the equipment, built out a room in our house. And then my wife threatened me at some point during the middle of 2013 that if I didn't utilize all that crap I bought and, use that room, that she was taking the room back and putting the stuff on eBay. And so that put the fire underneath my butt. And I finally did launch it January of 2014.
Thank goodness you did. You wouldn't be here otherwise.
That's right.
We'll talk about mobile home parks and parking lots in a second. But I found hosting this podcast over the past 8 years has really just helped me so much as a real estate investor. I tell people I feel like a jukebox because I've had so many different conversations about real estate that you could ask me any question and I probably have some sort of answer when it comes to real estate.
That's right. No, I agree with you. Absolutely. I mean, just that and just the variety of conversations. I mean, you and I both know there's a million and one ways, I like to say, to make money in real estate and just, you end up you end up coming across many different folks that have gone down different paths and they seemingly find success in a litany of different areas. And so it just, there's no right or wrong. It's kind of like find what, is in best alignment with you, like whatever that investment vehicle is in the real estate world and run with it. But yeah, no, so I've learned so much over the years of interviewing. Again, just, I don't even know the number now, but it's a lot. And many folks that are way smarter than I have been there, done that, been through multiple other cycles and just trying to, glean some golden nuggets and take something away from the conversation that we could in turn implement into our business. And we surely have. So it's definitely been a blessing. And I feel like I've gotten more value out of it than I've, maybe given out. So it's been a win-win all the way around.
I feel the same way. It definitely has been for me as well. You talk about all asset classes on your show, right?
That's right.
You focus really on mobile home parks and parking lots. And I know we had that conversation before, but just fill our listeners in, what is your asset class and why do you invest in mobile home parks and parking lots? What do you see the compelling reason for those?
Back at me before that, I've owned just about everything. And I still have personal, capital as a passive investor in a litany of other asset classes like multifamily, which I know that you're a big fan of, self-storage, medical office, industrial, assisted living, and a few others. So again, back to the point of there's a lot of different ways to make money in real estate. You just got to find a focus and then kind of go deep into that focus and try not to go too wide and dilute that focus. And so, but years past, I owned lots of of residential single family homes. Had a pretty big rental portfolio of over 100 units. And then I got into multifamily and we're buying smaller stuff like 12 and 24 unit properties. But over a few years, built up about 350 units of multifamily stuff. And then the crash happened. And then you started kind of venturing into different types of commercial real estate, trying to find like the next thing. And that's how I stumbled across mobile home parks. Like I literally, it was of all the asset classes back then, like the major food groups, right? You got multifamily, you got industrial, you got office and retail. Like those were like the primary food groups. And funny enough that, 10, 15 years ago, 20 years ago, office was probably the premier of all of them, right? Like that was like the, mostly owned by institutional groups. Like that was trophy asset type stuff. And today, very different story. In any event, I was looking for a way, post 2008, after I went through a few years of just trying to dig myself out of a hole. I was looking for, what's next, what's the next phase. And I knew that I didn't want to buy single family properties anymore, just lots of inefficiencies of that business model. And it just, I didn't want to go through that again. It took many, many years to build that what is, 100, it ended up being about 130 units. It took many years to do that. I'm like, how can I get there faster? I looked at the multifamily stuff I had owned. I'm like, well, that took way shorter time frame, and I owned a lot more units with that. And so we should probably look at multifamily. But during that exploratory mission, I call it, I met a guy by the name of Randy, through a mutual friend, and Randy was a banker for 30 years and then retired. And how he explained it to me was that he had lent on, he did agency lending back in the day when agencies first got into the mobile home park space. And mostly all they would lend on back then was like really high end premier stuff, like 55 plus communities here in Florida. And he explained to me that he saw retirement coming up, and within 3 years of retirement, he realized that he had always been on the wrong side of the P&L, is what he said to me, and that he saw his clients make a ton of money in the mobile home park space, with acquisitions, refis, and sales, and that was going to be his retirement. So he went and bought 3 mobile home parks at retirement, and that became his world. And he made way more money in those 3 mobile home parks than he had made in decades of being a banker. And so that's what introduced me to mobile home parks. He just gave me a lot of compelling reasons, Brian, as to why he chose that, outside of maybe, again, some of the other major food groups in the real estate world. Probably the most similar, multifamily, right? They're both really multifamily, just one has some various nuances from the other. But the big ones that really stuck out to me, here's what really sold me when I had that lunch with Randy. Here's what really sold me on, I need to go buy one of these things. He was like, number one, the stickiness of the residents is drastically different than that of a traditional multifamily. You get a lot more just transient folks in multifamily, and not in a bad way. Transient not being a derogatory term. It's just folks that they live there because they want more flexibility in their life, right? They want to stay maybe for only a year and a half, or 2 years, and then they're moving on. Maybe they're getting a job transfer. Maybe they're getting married and moving to a home, whatever. Whereas the mobile home parks, most of them are homeowners. They own that unit. And so they look at it very much as living in a subdivision. And some of these folks, even in our community, say we've got folks that have lived in some of our parks for over 50 years now. And there's almost a couple generations in there. They've got like kids and grandkids that live in there. And it's just like living in the same neighborhood, right? So that was a big one for me that really stuck out, is just, much lower turnover. And then, one of the other big ones was just that, some of the easier levers to pull on value add. That was a big piece of it. He had kind of went on to explain that, a lot of parks were owned by mom and pops, and, years past, water and sewer expenses were typically included in the lot rent. And so one of the big value add pieces, and that was a big expense line item, the water and sewer, especially when you don't have to pay for water and sewer. People abuse it. They just tend to abuse it, right? They wash their cars 3 times a week. They take an hour-long showers. Their toilet flappers are leaking and they don't fix them. They just let them run, right? And so, he said like that was such a big lever to pull. Most of the parks that he bought, literally he would go put meters in and then basically drop that expense, essentially to the bottom line, which was huge value add right out of the gate. And then the last one, and there's multitudes of them, but the last big one was just the lack of sophistication in the space. And lots of parks had never historically kept up with the market, kept up with inflation. And so just they're well below the cost of any other type of living, but by no means are the lowest quality of housing. In fact, there's many communities we own that I would all day long put it up against any, B+ vintage, maybe even A- vintage apartment complex, depending on what community you're talking about in our portfolio. And, the construction style very similar. One's made in the factory, one's made on site, but generally speaking, same materials are used. It's just one's horizontal, and it's in a horizontal type community where you got your own yard, and one's an apartment, which is typically multi-stories. But those are the big ones. They really stuck out to me, Brian. And I was like, well, gosh. And the last one, he's like, there's not a lot of competition. That was the last thing he said. He was like, it's a mom and pop industry. And that's changed over the last 10, 15 years. But back then, there just wasn't a lot of, if you knew, you knew. If you didn't, you didn't. It was just like a good old boy club. There was a few publicly traded companies too, ELS and Sun communities. Outside of that, it was just normal mom and pops. I own one or two, maybe a few groups like ours that own maybe 5 or 6, but not many of those. Mostly just individual owners. So I was excited to say the least. And I ran off and went and bought a park. And fast forward, that was 2012 when I bought the first park. And 12 years later, we're still buying them. It's still a great asset class. So
firstly, when you started, it was an unsophisticated space. But there's been a lot more, podcasts like yours, books, people out there teaching people how to buy mobile home parks. Are you finding that it has become a much more sophisticated space, and how so?
Yes, it has. It has. Just professional operators that have, just utilize more technology, have better collections practices, are investing capital back into these spaces. They're like actually injecting capital back into these communities, improving the communities in turn, trying to get the rents up to market, making upgrades, but ultimately also, getting rents up to market, driving revenues, top line revenues, even adding amenities. There's been a number of communities that we just finished putting in a pickleball court in one of the communities, just adding nice amenities that will just enhance the quality of living for the folks that live there. And historically what I would have seen, and this is not all mom and pops, because there's definitely some good mom and pop operators that ran a really tight ship and truly reinvested in their communities. But more common than not, what I would see is that, they build on a shoestring budget. They phased it out over a couple of years. They didn't probably have a lot of prior building experience. They just saw the trend and they had found a piece of land. They probably got some buddies together, some local graders, some guys with tractors, and they went to work and they built this community. And over the next 10 years, they filled it in, and it became their income source, their income stream. They probably, sent their kids to school, their grandkids to school, college, maybe. However, they never ran a business before, and they didn't necessarily know how to handle budgets accordingly, how to budget for future, capital improvements and repairs that were going to be necessary. And so they end up taking a lot of money out, but never have enough money to really budget to put it back into fully replace roads, which can be millions of dollars, right? Or replace infrastructure that's failing, or add amenities that the residents might enjoy, like a basketball court, tennis court, pickleball. Didn't exist back then, but you get what I'm saying? So they'd run it, take the money out of it, never put it back in. I think today it's a very different. We look at it as it's got more longevity to it, right? It wasn't just a quick money grab. This is a good business model. Now we see there's really longevity to it. It's a great opportunity for folks that are, that are seeking affordable housing options, but not necessarily have to live in the ghetto or subpar type, old beat up multifamily property or in the bad part of town. And so I think it's just the sophistication has brought a different set of eyes to the table, and is looking at it from a more professional standpoint, and not just looking at these folks as sources of paying their lot rent, sources of income, but these are my residents. Like I want the better quality experience I can create for them, the longer they're going to stay, and the more they're going to tell their friends about it, and the more the word's going to spread. And I think that was not the perspective for the most part from what we saw of things that we bought earlier on. It just wasn't the case at all. Very little money put back in, and just very little care. Maybe it looked great when it was built, but over time it just slowly degraded. And I think that's why mobile home parks got a bad rep. I mean, you had that happen. And then over time, as these units they get older, they get beat up, and the community gets beat up. It starts, whoever's willing to go live there with potholes in the streets isn't probably the same person that was willing to live there when it was nice, new, and pretty, right? And the quality of the tenant base is continually degrades and goes downhill. And then you end up with the place that everyone complains about. Not my backyard, right? And that's not the image that we keep, and that's truly not even the image for the majority of the industry. It's changed quite a bit over the last 10 years, and we're really proud to be a part of that.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Save the date for the Midwest Real Estate Investor Conference happening April 24th and 25th of 2025 in Grand Rapids, Michigan. This event is the perfect place to connect with fellow real estate investors, gain valuable insights, and elevate your real estate game. With a lineup of expert speakers and numerous networking opportunities, you won't want to miss it. In the past 3 years with high interest rates, there's been a lot of distress, especially in office. You've seen it in multifamily. People who have been in some multifamily syndications have seen the loss of their entire investment because of the high interest rates. And we won't go into the reasons, but there's been a lot of distress. And you hear like blanket statements like real estate's about to crash. Commercial real estate is a terrible investment. What's your take on that? Because obviously you're in a asset class that probably has done pretty well over the past 3 years.
Historically, mobile home parks have thrived during recessionary periods. So the data would suggest that they had this asset class had I think some data points are conflicting out there saying that self-storage had the lowest default rates during the last recessionary period. Mobile home parks did. Either way, it's very low. It does great when the economy is booming, but also does great when the economy is struggling. Because again, folks, we know this multifamily serves the same purpose. We know there's a huge shortage of affordable housing in this country. We are helping, fulfill that void, and mobile home parks do a great job at it. So I haven't, surely there's individual struggles in our space. I'm sure there's folks that maybe overpaid for something, or maybe just got in thinking it was an easy business and it was a set it, forget it, and didn't really have the operational expertise, or maybe even could buy it, but didn't have didn't budget the capital necessary to to manage the CapEx improvements and just operational carry to get it turned around. That happens everywhere, though. That happens in every asset class, and so I don't think ours is any different. But I haven't seen too much. I think we were talking about this earlier. I think a big part of why I haven't seen a lot of distress in our sector, and it's been fairly isolated incidents, right? But most of it is that a lot of what's happening in multifamily is a function of the debt structure, the debt vehicle that was put in place, and no one knew the interest rates were going to go up at the rate that they did, historical high levels in a historical period of time. And no one expected that. Even the best investors didn't expect that. But the primary business model multifamily, at least the value add play, was placing bridge debt, that ultimately had a floater and had a rate cap that were to expire at some point, and a loan term that were to expire. And we know how that all plays out. Like it's a challenge that becomes very expensive and very hard to maintain. And I don't think that part of the business model existed so much in our space. I can literally, one loan that we've ever taken on that was truly a bridge loan. Most of the time, if we do a bridge loan, at least what we classify as a bridge loan in our space, at least in how we do it internally, is we'll get a bank loan. If we won't buy a property that won't at someday qualify for Fannie or Freddie debt. So like it's got to have the ability to get to an agency loan at some point. Like maybe we got to fix occupancy, maybe we got to make improvements, pave roads, whatever it might be. But we know we can get it there with money and time. And so in the interim, we'll put a bank loan in place. We'll get a recourse loan, 5-year term, 25 or 30 amortization, higher rate, typically a higher rate by a lot of times 150, 200 basis points higher than that of what agency might be once we get stabilized, but not some of the egregious terms that are associated with some of these bridge loan products, right? Like they're they're tough. They're tough. If things do not go well, which they haven't, they're really difficult. The lenders a lot of times are difficult to work with. Rate caps are incredibly expensive, and it basically handcuffs the deal. And we just haven't seen that play out so much in our space. Knock on wood. And we've also been pretty conservative of what we've done over the last couple of years. Brian, I went through this before to a certain degree, not the same thing by any means, but I lost everything once, and I was kind of like, my partner and I would always have a push and pull. He does the most of the capital raising in our company and handles the finance side. And I handle, deal flow acquisitions and the operational side. So I kind of oversee the ops after we acquire something. And when times were good and capital was flowing in, we had more money than what we could place. And I was, there was always a struggle. I'm like, Brian, I'm not going to buy something just to buy it. I know everyone else is buying, and maybe they're underrating. I don't know what they're doing because it doesn't make sense on my model. And same thing goes to the things that we sold during that time frame, like late 2020, 2021, and 2022. I'm like, we pruned out our portfolio quite a bit. I'm like, I don't know how they get there. I know this park. We've owned it for 5 years. I have no idea how they get to that price point. I'm very far away. There's a big delta where what I think the max value of this property is, and we've extracted a lot of value of it already. I don't know how they get there. So let's sell it off. And fast forward a couple of years, I think it was a good decision for us to be conservative in that time frame, because now it's put us in a good position. We don't have any debt that's floating. We don't have any terms that are coming due anytime soon. Not in the next, I think about 2.5 years is the soonest that we have something coming due. And it's just, we slept pretty good at night. We've been able to buy stuff in the past year when other people haven't been buying. So it's been a good time for us. But again, I think I don't want to do that again. And not saying that anyone knew that this would happen this dramatically, but I'm at a point in my life where I want to, nice and easy. I'm not in a race here. Nice and easy. Let's do deals when deals make sense, and let's sit on the beach or go hang out with our family when deals don't make sense and we're not buying.
I'm curious, with your residents at the mobile home parks, what's your economic barometer? I mean, are you seeing people paying? Are you seeing any delinquencies? What does your economic barometer tell you when you look at who's paying and who's not paying?
We kind of run the gamut. So like using a star classification, system of, 1 star being like, don't even send your worst enemy there during the daytime, like stay away from that place, to a 5-star being very much like a lifestyle community, not being affordable housing, lifestyle community down here in Florida, Arizona, California, second home for people, snowbirds, 3 swimming pools, palm trees, that type of stuff, right? So we tend to own in the middle of that spectrum. And I'd say we don't even really have any 2-star parks. Most of our stuff, if it was a 2-star, like it's somewhere in the 2.5 to 3-star range up to 4-star. So like we're right in the middle of that spectrum there. And I haven't seen anything significant that would note, that we're in a recession as it relates to like late payments, with the exception. So we've owned in some blue states. We no longer own in New York. We did years past. Rent control got passed in, I think it was 2020, and we got out of there as fast as possible. However, we still do own some assets in Maryland, which we've owned for many, many years. And, our basis is low and they're great assets. We know them now, and we're very cautious about buying in Maryland. We still will buy in Maryland, but we're very cautious about just the regulatory risk and it just, the general sentiment of the people, right? There are red parts of Maryland, but Baltimore is such a big influence on the entirety of the state that it bleeds out over everywhere. So where I'm going with that is that Maryland parks, although they're probably 3.5, 4, one of them is a 4-star community. It's more of a selective choosing not to pay scenario that I've seen play out. And it's not a big issue today, but I have seen it tick up in those 2 communities. And the only thing I can tie that back to is just the court system's a lot slower there. It takes a lot longer to get them out. And they've got protections that don't necessarily exist in some of these other markets that we own. And
so it's a little bit more of a political risk that you're taking there, more so than like a recessionary or economic risk that you're seeing around the country.
That's right. And we own, and I don't know if you can really put your thumb on it. I'm just trying to, I'm given what I see. I have not seen, like, broad brush strokes. We haven't seen a rise of delinquency across our portfolio yet. That doesn't mean it won't happen, right? Like, I think we're just at the precipice of what might occur as far as recessionary times, right? And I think we're kind of hanging on there by a thread until we see what happens in this election, right? But I think it will get worse before it gets better. And so we do anticipate that there surely will be some uptick in delinquency. To what rate, I'm not sure. I would say the one good thing that I've always really loved about our asset class is that, like, our average lot rent throughout the entire of the portfolio, we have some parks that are like $700 a month, and we have some parks that are in like the low threes. So it's a pretty big range. But let's just go right down the middle, right? $500 a month. If someone, if they prioritize their expenses, they lose their job, and like obviously the roof over your head should be the number one priority, right? And so if you got your priorities in order, and you lost your job, and you got to figure out a way to come up with $500 that month to make your lot rent payment, so that you don't run the risk of being evicted or your home being evicted out of the park. I'm not going to say it's not hard to make $500, but there's a lot of things that one can do to scrape together $500, whether it be go sell bottles of water on the side of the road for $1 a piece, or, pawn something. Much different than that of trying to maybe come up with what might be a $1,500 a month or $2,000 a month payment that could be in a rental home or a nicer apartment or something like that. So, and then on top of that, I think there's a little bit more of an incentive for them to figure out a way to come up with the $500, because not only do they run the risk of not being in that park anymore and being evicted, but they also run the risk of losing that home, because if they can't afford to move it out of the community, then ultimately what happens, they have to leave the community, and then we have to go through an abandoned title process, and we end up with the home, which we would rather not have, because it's a pain in the butt to do it, and it takes a lot of time. And so I'd rather them to stay in their home, keep the roof over their head, and just figure out a way to pay the lot rent. And so it just, but I'm not saying, I do believe we'll see an uptick. I do believe it. But right now we're not really seeing it, with the exception of Maryland. So, and I'll try not to keep that political, but I believe that it is, because the same thing happened during COVID. The same thing literally happened in COVID with Maryland and with New York. Those 5 communities in total, all really nice communities. Lots of them on fixed incomes. Didn't have even a financial impact as a result of COVID, and ultimately just selectively choose not to pay when they don't want to pay.
Let's talk about parking lots briefly. I mean, I know that's the other asset class you're focused on. What does that look like for you in the past year or 2 years? Have you been able to find some opportunities, and how are those working?
Yeah, we have, and it makes up the minority portion of our portfolio. We did we bought a parking garage last year. So we basically, in the last 4 years, we bought a parking asset, one per year every year, basically, is how it's played out now since we've been buying parking. We look at a lot, unfortunately, lots of parking that was built, if it was like a parking garage and it's in like a downtown area, a lot of parking garages that were, purposely built as parking garages, back when they were built, maybe 20, 30 years ago, were built to service mostly office, right? Office tenants. And while there might be also transient makeup or government, courthouse, something like that, a lot of parking still, was originally built to service office, which we don't have any interest in. And so, like, if that was the primary demand driver of that parking facility, I don't know how to fix that. If they're not back to work now, I don't know what the future looks like. It doesn't look bright, right? And so we look at way more deals and pass on them than what actually check all the boxes for us. So the one we bought last year, it checks all the boxes. It's right in downtown Phoenix. Literally, it is as close to the courthouse as you can get. Like, literally, the front steps are like a stone's throw away from the entrance of the garage. So you got and the courthouse there, Maricopa County, is the second largest in the country. So you got the courthouse. Downtown Phoenix is thriving. I mean, it's daytime. It's a 24/7 city now. There's restaurants, there's lunchtime, there's dinner time, there's clubs, there's recreation. Tens of thousands of new residents being built in downtown area. So anyway, like, it's got a lot of variety. It's got a major variety of parking demand drivers for that garage. And so we bought that last year, and that was an institutionally owned property by Invesco. I think they're in the top 3 largest of institutional owners in the country. And they had a debt maturity. They had a debt maturity come and due, and they missed the mark. And so we actually made an offer on this property. It came to market June of 2022, or maybe like May, but it didn't get legs until like June or July. And that was right when rates were starting to go up, right? And so it came to market, and we were second in line. We didn't make it to highest and best, and we didn't get awarded the deal. It was 28.6 was our offer. And I never was informed of what it actually went under contract for, but probably somewhere between that and $30 million. Rates continued to go up. The guy had under contract, had a bunch of capital calls on other projects, and essentially got a call in October that the deal died. He backed out of the deal, and it came back to live. Now they're on their second term renewal or extension on their loan maturity, and so that now they're a little bit more pressured. Obviously, rates had gone up. I don't forget about how much by that period, but we closed in the middle of last year. So it took about 6 months to close it. But when it was all said and done, we ended up closing on it for $15.4 million. So almost half of what we would have paid for it. And it actually would have made sense even at the 28.6. So again, not a distressed deal, just a distressed situation. They had COVID had kind of pushed them past their time horizon on that project. It had some retail associated with it. It was an old historical area that they were revamping, and COVID delayed that. And so lots of these institutional groups, man, they don't have leeway. They got to be in and out, right? In and out, and they get pressured to get out at all costs. And so they got out and we got in.
What a great opportunistic investment there.
Yeah, no, it's been great. It's outperformed every month for the last year that we've had it. It's absolutely been kicking butt. It's fantastic. It's irreplaceable. We look at it as this. It's irreplaceable real estate. Like it's in its lowest form today as parking. And it's on almost a half a city block in downtown Phoenix, one of the fastest growing cities in the country. Like it does incredibly well financially as parking today, and will inevitably have a higher, even better use and a higher value at some point in the future, whether it's 10, 20 years, whatever it might be, as something else, right? And so we can have as a cash flow uncovered land play, do really well with it. And when the time comes, whenever that is, turn it into something else, that's in demand at that point in time. So we've got a parking deal in contract right now that we've been working on for a number of months. And I think it's actually going to make it. It's very complex, but it's in special servicing. It's a garage tied to a hotel. Garage is standalone, but it's associated with a big office building, and then also a hotel. The hotel is still doing really well. The office, the guy that had the loan on it had it cross collateralized between all three. The office took this whole thing down. The garage is still performing quite well, but the office is sucking wind, and it's putting it in a very precarious state. And so, but it's in a phenomenal market. It's in Charlotte, just a phenomenal location. And I'm not going to talk too much about it because we're not there yet on it, but we're in contract, but not close up. I don't want to jinx it. So, but again, distressed situation, CMBS loan that now is in special servicing and fell below the 1.25 debt coverage ratio. I think it's with the office where the vacancy is in the office. I think that the office only has like 23% occupancy, like a 0.68 or something like that. So they're really short, woefully short on their coverage ratio there of covering the debt cost. So they got to sell.
You're separating it from the office building, I take it.
Yeah. So what it is actually a very complex deal. So they're all standalone, but they all sit on one parcel ID. And so we're working with another group that's going to take that. They want the office and the hotel. And they're really good at doing office to residential conversions. They've already done like 3 in downtown Charlotte. So they're really good at it. That's kind of their MO. There's another guy they're going to hand off the hotel to. That's a hotelier in Charlotte. So anyway, they've got kind of that piece of the puzzle, but part of the contingency and we're going to, it's the easier part of the entire deal, but we're going to create individual parcel IDs. We're going to basically, subdivide the plat, and we're going through that process right now. And that's one of the contingencies we got with the servicer, because we're like, hey, even if we don't close, you get this back in a better position to sell this. Like, you got more flexibility. Even if this thing completely blows up and no one closes on it, number one, you get earnest money, Mr. Servicer, Mr. Bank, but you also now have a product that is much more sellable because it's on its own individual. It's 3 individual properties now versus just, 3 properties on one parcel, which is kind of silly they did it that way because they're not connected at all. There's a sky bridge that connects them, but they're individual structures. They're not connected like wall to wall.
Tell our listeners how they can find out more about you or get a hold of you.
You can go to our company website, investwithsunrise.com. You can, reach out to me there, but we also have a lot of other resources. We've got a current offering that's out there. We do things in a fund structure, and it's a blend of both parking and mobile home parks. So you can learn about that opportunity there. And, we've got a lot of other information there. Like, we're pretty transparent. Like, we provide appraisals of properties, third-party reports. We put all that up there. We kind of give an overlay of the business plan, give details on maybe historical deals we've done or going full cycle on. And so there's some good reading there. You can kind of get a sense of who we are, what we do, and I guess just what our real business model is, like how we find value in these 2 different asset classes. So, and again, if you use the contact us there, it will make its way to me one way or another.
That's at investwithsunrise.com?
That's correct. Investwithsunrise.com.
And what is your favorite hack or app?
We've been using it for years, but I still love it today as much as I loved it, 4 years ago when we really rolled it out in the organization, is Slack. I really like it as a communication tool. I hate email with a passion. I've never become really efficient with email, and I feel like I only get buried more and more, no matter how many, processes I try to put in place with different folders and organization, this, that, and the other. it just seemingly overwhelms me. I don't know why. And so Slack has become a way for me to just stay much more organized. Folks know they can communicate with me via Slack and they'll get me right away. And it's just create dedicated, it's Slack, so you can create dedicated channels. So we have a dedicated channel for like our marketing division, for the IR division, for, even deals that we're working on. And so it's a much cleaner form than that of email. So Slack has been a big game changer for us within the company.
Thanks for coming on the show today to talk about mobile home park investing, how you've been doing with it over the past couple of years, when there's been some turbulence in the market. But for you and your asset class, it sounds like you're doing great. So I'm happy for you there. And the parking lots and the parking ramps. So really interesting stuff. Thanks for coming on the show to share it with us today.
I appreciate you having me, Brian. Always fun catching up with you, my friend.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. And remember to save the date for the Midwest Real Estate Investor Conference on April 24th and 25th of 2025 in Grand Rapids, Michigan. It's going to be an event you won't want to miss, packed with invaluable sessions and opportunities to connect with like-minded investors. Keep listening for more updates, and we look forward to seeing you there. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.